Hey, welcome back to the What You More podcast. I'm your host, Quinton Harris. You're dialed in for another episode here at What You One More. Obviously, look around. It looks a little different, feels a little different. That's because we're transitioning studios right now. I cannot wait to get into our new one and kind of give you guys a peek at what we've been putting together there. But we decided to move studios, create like a multi-use space for our friends and family and other people that have been asking to use our podcast. We're real excited about this. Stay tuned. That should be ready by the end of next week. But till then, you're actually in like my domain right now. You're actually where I do all of my business, all of the economic projections, and do a deep dive into many of our topics that we talk about here on the podcast. So today, obviously, I'm going through it's Veterans Day. Beyond the Veterans Day post, it's sad I'm seeing more posts on the 50-year mortgage topic conversation than we're seeing on a Veterans Day. But I think it kind of goes with the notion of facts over fear. We talk about this on the show all the time. It's one of the things that we're going to continue to talk about. But this is a great example, right? The idea of a 50-year mortgage and what could be accomplished here. And I think what we're talking about is, hey, creating affordability. There's an idea. Let's just extend the term out. A lot of people use cars. If you remember, cars are really highest term you would have seen, 10 years ago was 60 months. Now it's 84, right? In some cases, 96. But you take a look at the 50-year mortgage here, and it's interesting, like I'm doing a podcast on this because it really doesn't require a podcast at all. You could sum it up in one thing. That is, it takes an amendment to the Dodd-Frank Act that was put in place. And it takes an amendment to the QM rule for that to even happen. And that's totally not even being talked about at all in any of these social media posts. And you see people breaking down payments, talking about affordability, all of the rate changes that could take effect. But the reality is none of that happens without the QM rule being changed, which was a portion of the Dodd-Frank Act. Now, maybe the non-QM space can come in there. You've heard us talk about those particular loan programs. But the reality is this. Those rates are typically higher than your standard conventional loans, which is going to kind of mitigate the affordability there. So what I'm going to do in this podcast is I'm kind of going to break down the rules and the laws that would have to be amended and changed. I'm also going to show you these payment options that people are referring to on the what if scenarios if rates were to be increased because of the 50-year term. So I'm going to go through that and a little bit more in this episode of What You One More. All right, so welcome back here. So let's talk a little bit about the regulation and kind of what came about with the Dodd-Frank Consumer Protection Act. We normally call this the Dodd-Frank Act, but it has a longer name here. The reality is there were a lot of things put into place to protect the consumer. One of those was the qualified mortgage rule. And inside that qualified mortgage rule were a lot of things like you can't have a prepayment penalty on these types of loans. The term can't go beyond 30 years. There were some things you couldn't have negative amortizations inside of it. A lot of things were put in place to protect what happened from, 2007 and prior to that we felt as an industry kind of propped up this real estate collapse that happened. Extending to a 50-year mortgage goes beyond what's allowable in that particular law that was passed. And so to think that, hey, listen, we're just going to come up with a 50-year mortgage, throw it out there, and Bill Pulte kind of, tongue-in-cheek said, yeah, it's on the way, it's great. Maybe a little overzealous there. Some are claiming it's a little irresponsible because the reality is this isn't something they can just change overnight. I mean, we still don't even have the federal government back working yet. And I guarantee you when they come back, the top priority is not going to be, hey, let's get these 50-year mortgages done and amend the Dodd-Frank Act. That's not the case. So, but with that being said, let's play the what if game. And I want to make it abundantly clear. This is all this is. It's a what if game. Yes, you could have the non-QM space come in tomorrow and say, oh, hey, guess what, Quinton? We did it. We've got a 40-year and we've got a 50-year. It's going to come with a rate bump because the old financial formula still holds true. The greater the risk, the greater the reward. The longer the term is the greater the risk. The higher the reward is the higher the interest rate. That's going to be the case every single time. So what is going to happen is with these 50-year mortgages are going to come higher rates, whether it's on the conventional side, pending they can change or amend the Dodd-Frank Act, or if it's on the non-QM side. There's not a single investor that's going to wait 50 years and give you the same rate as if it was 30. Now, I know a lot of people online, there's putting out a lot of propaganda about this, a lot of opinions. And I think it's really important to understand, this is an opinion. What I'm sharing with you today is a fact. The fact is higher rate on a longer term. Fact is the QM rule is going to have to be modified for that to become a conventional loan in any capacity. Those are just facts, and that's not going to happen overnight. But let's assume it did. For the assumption of this, let's assume. So if we're looking at today's 30-year fixed rates, they're somewhere in the range between 6.375 and 6.5. If you go back in time to 2005 and 2006, when 40-year terms, yes, 40-year terms were a conventional product during that time with Fannie Mae and Freddie Mac, you saw the rate bump take effect to somewhere to the notion of about a half a point. So let's add that half a point into this equation, okay, for a 40-year term. And let's just assume that that's what it's going to be for a 50-year term. You know, a couple charts here. If you're listening and you know we like to do charts, if you get a chance to go to our YouTube channel, check us out at What's Your One More with the number one. That's What's Your One More with the number one. Let's look at this breakdown here. And I've got it up on my screen here. And let's look at the difference between a $300,000 loan, a $400,000 loan, and a $500,000 loan in regards to a 30-year versus a 50-year with that rate assumption I just described. So let's start with $500,000, and I'll probably just end with that one as well. But if you were looking to buy a $500,000 loan and you were doing it today's market rate of that 6.375 I'm describing on a 30-year term, that'd be about a $3,100 payment with principal and interest. This does not include taxes and insurance. If you do that on a 50-year at 6.8, it's $2,932. Your savings is $169 a month. Now, is that massive affordability being created? I couldn't tell you. That's up to the person's budget and their lifestyle. Me personally, I don't think that affordability offsets the dramatic amount of interest being paid for the additional 20 years. Because the difference in interest is about $642,000. Because the interest on that 30-year, it's about $620. The interest on that 50-year is about $1.3. It's a lot of money being paid in interest, which is why this 50-year conundrum, if you may, it's not allowable in the QM rule. It's because it's not a direct benefit to the borrower. The $169 savings per month over that 20-year term does nowhere near offset the $642,000 in interest on the term of that loan. I think this is the flaw, right? It's kind of like when you get people excited about something just because you said it with no facts behind it, or just because you put it out there with no, research and R&D behind it. That's where I think it's a little irresponsible. And if you listen to the show, like I support a lot of the endeavors this administration is doing. I really like some of the ideas that they're coming about. This is one of those that I thought was a little silly. Personally, hey, shout out to my friend Barry Habib. I think what he's doing with sitting down and getting the LLPAs removed on cash out refinances, now there's a benefit. That's a direct benefit to the consumers because now we're getting lower interest rates, allowing people to take equity out of the home, pay down some of the debt they owe, maybe even stimulate the economy through other purchases. Now that's a win. That makes sense. And that's doable without having to modify the QM rule or having to go to the Dodd-Frank rule and modify that, or Dodd-Frank Act and amend that. All of that. Now that makes sense to me. And see, that's forward thinking. He also wanted to remove some of the LLPs on second homes. Again, stimulating the economy, moving inventory, homes are being sold, transactions are taking place. Those are all things that can be done at the FHFA level and not have to go to a congressional level. That makes sense to me. The notion of a 50-year mortgage, to me, was something that when I saw it, I thought, you got to be kidding me. Because honestly, I thought it was a joke at first. I really did. I even saw someone recently go as far and post, hey, just so you know, 15-year car notes are coming out next. Announcement from the White House. I mean, that's how ridiculous the 50-year sounded. And I understand the principle behind it. The principle behind it was, and this goes back to why I agree with the economic push that this administration is making, is we want to focus on affordability. We want to help people buy homes. We want to be homeowners. I get that. I think that's really important. And I think putting a 50-year out there is just showing what extreme measures they're willing to go to get that. I don't think there's any backing behind that getting done. I could be wrong. We could be talking a month from now and I'm like, wow, I can't believe we're doing a 50-year mortgage. It doesn't make sense. I don't think that's the case. I think this is more of a measure of saying, hey, in good faith, I'm wanting to show you guys as an American public how far we're willing to go to get this done. I don't know that we can do it, but this is what we're aiming for. And I think that was more of the post than it was, maybe this didn't really have a lot of teeth around it, in my opinion. Again, I could be wrong, but take a look at these charts. Another thing we'll show on there is that total interest paid, and you'll kind of see the difference between the 30 and the 50-year and a bar graph on there as well. And it's substantial. I mean, it's night and day. That's why even the 40 years don't make sense anymore when you take a look at it, because it's still so far-fetched, which is why that qualified mortgage rule was put into place. So guys, if you like what you're hearing, please share this. It's going to be a short podcast. We're in the middle of my office, had to move some things here. Got to get back to work. But hey, next time I'm talking to you, it'll be in the studio. I'm looking forward to that. Looking forward to showing you guys the new digs that we got over there. And I just want to say, hey, thank you to my producer, Charlie Walker, for making this happen, because this was a real last minute throw it together, get it out there. But guys, hope you like what you're hearing. Please 5-star review this. Continue to pump comments to us on YouTube. Check us out on our channel, What's Your One More with the number one. And guys, as always, thanks for tuning in to What's Your One More. We'll see you the next episode.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.